Asterisk asterisk US dollar falls. Trump's presidency faces major stress test asterisk asterisk. What? If the most powerful currency in the world isn't as unshakable as we think? For decades, the US dollar has been treated like gravity, always there, always pulling everything toward it. Wars, recessions, political scandals, even pandemics have come and gone, yet the dollar survived, often stronger than before. So when headlines begin to whisper that the dollar is falling again, the instinctive reaction is to shrug. Asterisk, it's temporary. It always comes back, asterisk, but this time something feels different, because this time the stress test isn't just economic. It's political. It's psychological. And it's tied directly to the return of a figure who reshaped markets not just with policy, but with words. Welcome to its financial history, too. If the dollar truly weakens under Trump's presidency, the mystery isn't whether markets are overreacting. The mystery is whether the global system built around the dollar has finally reached a breaking point. To understand why this matters, we need to step back far back before Trump, before modern trade wars, before social media diplomacy. We need to understand how the dollar became powerful in the first place, and why that power was never guaranteed. After World War II, much of the world lay in ruins. Factories were destroyed, currencies were shattered by hyperinflation, and trust in money itself had collapsed. The United States emerged relatively untouched, with massive industrial capacity and the world's largest gold reserves. In 1944, global leaders met at Bretton Woods and quietly rewrote financial history. The dollar was placed at the center of the global system, backed by gold, while other currencies were tied to the dollar. This wasn't just an economic decision, it was a political one. The dollar became the bridge between nations, the language of trade, and eventually, the storage unit of global wealth. Even after the gold backing ended in the 1970s, the habit stuck. Oil was priced in dollars. Debt was issued in dollars. Central banks hoarded dollars because everyone else did. The dollar's strength became self-reinforcing. Trust created demand. Demand created stability. Stability created more trust. But systems built on confidence have one hidden weakness. When confidence cracks, it cracks fast. Fast forward to the rise of Donald Trump. His first presidency didn't quietly fit into the old global playbook. It challenged it openly. Alliances were questioned. Trade agreements were torn up or renegotiated. Tariffs returned as weapons. And for the first time in decades, a U.S. president publicly criticized the Federal Reserve for being too independent and too powerful. At first, markets dismissed the noise. Stocks rose. Growth continued. The dollar remained dominant. Yet, beneath the surface, something subtle was happening. The United States was signaling that the old rules were optional. That signal matters more than most people realize. Currencies are not just backed by interest rates or GDP numbers. They are backed by credibility, by predictability, by the belief that tomorrow's rules will look roughly like today's rules. When unpredictability becomes policy, investors start asking uncomfortable questions. The origins of the current stress test begin here. As Trump returned to the presidency, global markets didn't just evaluate his economic plans. They evaluated risk. Tariffs hinted at higher inflation. Pressure on the Fed suggested political interference. Aggressive rhetoric toward allies raised questions about long-term cooperation. Each of these alone is manageable. Together, they form a chain reaction. Higher tariffs increase costs. Higher costs push inflation upward. Inflation pressures the central bank. If the central bank is seen as politically constrained, its credibility weakens. When credibility weakens, foreign investors demand higher returns or they look elsewhere. This is how cause and effect quietly works in currency markets. There is no single collapse moment. There is drift. At first, the dollar's decline looks mild. A few percentage points. Analysts argue over technical factors. Media attention is limited. But for central banks holding trillions in reserves, even small moves matter. If the dollar is no longer a one-way bet, diversification becomes logical. And diversification is contagious. As the dollar's rise over decades created a habit, its hesitation can create a new one. Gold allocations increase. Regional trade agreements explore non-dollar settlements. Emerging economies talk quietly about alternatives. None of this makes headlines immediately. But history shows that reserve currency shifts never happen overnight. They happen through accumulated doubt. The breaking point doesn't come from one bad policy. It comes when markets realize that fixes are no longer automatic. When inflation fears rise, the usual fix is higher interest rates. But higher rates increase government debt servicing costs. When debt levels are already high, that fix creates political pressure. When political pressure targets the central bank, confidence erodes further. This is the trap. Under Trump, promises of growth through protectionism clash with the math of global finance. A strong dollar hurts exports. A weak dollar fuels inflation. Trying to control both at once is like pressing the gas and brake simultaneously. As the dollar weakens, the fallout spreads unevenly. Imports become more expensive for American consumers. Energy prices fluctuate. Foreign holders of U.S. debt reassess risk. Meanwhile, competitors benefit quietly. A weaker dollar makes other currencies more attractive for trade settlement. It lowers the barrier for alternatives to emerge, not because they are perfect, but because the dominant option looks less stable. History offers uncomfortable parallels. In the 1970s, after the U.S. abandoned the gold standard, the dollar plunged, inflation soared, trust collapsed. It took brutal interest rate hikes and a deep recession to restore credibility. In the early 2000s, massive deficits and loose policy weakened the dollar again, pushing investors toward commodities and emerging markets. Each time, the pattern repeated: denial, drift, panic, and painful correction. The difference now is scale. Global debt is larger, markets are faster, information spreads instantly. And political polarization is deeper. What once took years can now unfold in months. Attempts to fix the problem often fail because they treat symptoms, not causes. Temporary rate hikes without long-term fiscal discipline. Trade deals that don't restore trust. Verbal assurances that conflict with policy actions. Markets listen to actions, not speeches. As the story reaches the present, the stress test becomes clear. The question isn't whether the dollar will collapse tomorrow. The question is whether the world still believes the U.S. will protect the system that made the dollar dominant, even when doing so is politically inconvenient. Because reserve currency status is not a birthright. It is a responsibility. When we connect this to modern data, the pattern sharpens. Global central banks have been gradually reducing dollar concentration. Bilateral trade agreements increasingly bypass the dollar. Gold purchases by central banks have surged compared to past decades. None of this signals immediate disaster, but together, they rhyme with history. And history rarely repeats perfectly, it echoes. So what does this all mean? First takeaway: the dollar's strength is built on trust, not inevitability. Political pressure on institutions can weaken the currency long before economic collapse appears. Second takeaway: markets react to patterns, not promises. Small policy signals accumulate until confidence shifts, and when it does, reversals are difficult and costly. Third takeaway: the real risk isn't a falling dollar, it's complacency. Assuming it can't happen here is how every financial surprise begins. The warning is simple but uncomfortable. If the U.S. treats its currency dominance as a weapon rather than a responsibility, the world will slowly build alternatives, not out of rebellion, but out of self-preservation. And the open-ended question remains: when the next global crisis hits, will the dollar still be the unquestioned safe haven or just one option among many? If you want to understand how power really shifts in the modern world, watch currencies, not headlines. And if this story changed how you see the dollar, the presidency, or global stability, make sure to like the video, subscribe for deeper breakdowns like this, and share it with someone who still believes money is just paper. Because history shows us one thing very clearly: when confidence moves, the world moves with it.